Welcome to another webinar. This morning we're going to talk about using Fibonacci with Elliott Wave Theory. Okay, and so let's just kind of recap where we're at so far. As you guys know, my main trading strategy is basically to trade the market looking at it as an emotional cycle. It's kind of the only way that I've found that really works, because it seems like the only thing consistent in any market is the emotions of the traders. And so, you know, this document is public. It's been around for a while, but like I said before, I saw it and took notice of it, but didn't pay it much mind as far as the actual emotions that were being played out, until I realized I was losing because I was, experiencing these emotions and falling prey to these emotions. So the main principle and strategy that we're keeping in mind from the very beginning is that every single move that the market makes is an emotional move. Okay, and it's leaving a print on the chart that is very measurable. And we can find this pattern, like we discussed. We can find this emotional structure in every time frame. Okay, and the way that the Elliott wave manifests itself is waves within waves and fractals that lead into other fractals, and these sub-minute waves that lead into these larger red waves that lead into a larger blue wave, and that may even lead into a larger wave on a higher time frame. So once we recognize that this is the same emotional structure playing out over and over again, and it is manifesting itself through these waves, these impulses and retracements, then we find that we can measure these impulse and retracements with the Fibonacci tool, which really seems to make a lot of sense, because I was discussing with one of my students last night is that when I really think about it all, like all the pieces of the puzzle, I really think that Fibonacci is the key to it all. Meaning that, everything in life unfolds according to this Fibonacci spiral. Everything in life unfolds according to this Fibonacci spiral. So why not, we're using that Fibonacci spiral to tell us where the market could grow to or where it could decline to. And, we can put the spiral on the market here and use it as a tool. And it just kind of gives us a rough estimate of saying, this move here could grow into a larger move here. And actually, if we really want to get specific with it, that rest of that Fibonacci spiral is landing somewhere higher up. Okay, higher up. Meaning that at some point in time, from this emotional move that happened here, it's very well possible for this to grow all the way up into here. Okay, at some point in time, it very well is possible. Not saying it's going to happen right away or in this altcoin season or whatever, but I mean, it very well could, honestly, with all this volume of momentum and limited supply. But what the Fibonacci tool is telling us is where the market could go based on the measurable impulse that it gives us. And so just to point out the Fibonacci spiral here, because this is what we looked at in our last session, how this formula of how life grows and unfolds is in everything. I mean, literally everything, from anything in creation. I mean, anything natural in creation, in nature, flowers, fruit, waves, our galaxy, our human DNA. I mean, everything unfolds to this mathematical formula. So, and the ancient people used it for designing their buildings and putting it into their artwork, and their it was part of their culture. Like, they understood the power of utilizing the Fibonacci ratio and utilizing the golden ratio of mathematics. They understood that it unlocks some sort of some sort of an unseen energy or some sort of a sacred science that if they designed their buildings according to this harmonious flow, or their artwork, or whatever they were designing had this harmonious flow, then it would be more appealing, or the recipients would be more receptive to it, because there's some sort of harmonious energy that's being captured there. And so I really think that Fibonacci is the core of everything that we're seeing in the market. Like, everything is unfolding according to Fibonacci. And what happens is, when a price moves and it impulses out and it starts a new cycle, it's going to wind up being this emotional cycle. Okay, it's going to, like, once we hit that point where we break out and something hits disbelief and then it continues on, it's going to complete this entire cycle here. And that cycle will manifest itself through these Elliott waves, meaning that entire cycle will be a big grand wave, and we'll be playing little waves within waves and bigger waves and larger waves all along the way. So basically, what I've come to find is that as soon as there's a sharp move that's made into the market, this is the end result. Okay, that move is measurable with the Fibonacci tool. And that Fibonacci tool is telling us that it's possible that we could expand in price, or we could grow all the way to these levels. And the way that we're going to get there, and when it's all done, it will be an emotional cycle. But the way that we're going to fill that gap between here and here is going to be this. It's going to be this Elliott wave, impulse, retrace, and then, a retracement of that whole move, and then impulse and retrace, and another retracement. And what that's doing is it's painting smaller sets of waves, and then larger sets of waves, and then even larger sets of waves after that. So just kind of, thinking outside the box a little bit. And that's the only way that I found that I actually started gaining when I was trading, is to actually step outside and think about the market in a completely different way. We're literally trading the market based solely on emotional patterns, nothing else. My entire strategy is based around the predictable emotions of human beings and how we can measure that through the Fibonacci tool, and how we can map that as it's happening through the Elliott wave. And every other indicator, trading tool, and everything else is just used as confluence. Literally, there's a whole list of things here on this indicator list, a whole list of stuff that I don't even use. And honestly, guys, stuff that I don't even know how to use. I'll be honest with you, I don't even know how to use a lot of this stuff on here. And I've tried it, and it just doesn't seem to make any sense for me. Most of these indicators are made by people trying to figure something out that they can attach to, or come up with some sort of a trading strategy with some sort of an indication of a trade. And I really feel like that's, kind of relying on one indicator or another to tell you to take a trade. And that will work only a small percentage of the time, But in reality, the only thing that's consistent in every market is the emotions of the humans that are trading the market. This is what's playing out every single time in every time frame, and it's playing out according to this map and this blueprint, which is all measurable. All these moves are related, to each other with Fibonacci numbers. So it really occurred to me that a lot of this stuff is just, not so much junk, but it's just not even needed. I think a lot of it started with Forex, where they give you, I don't know if any of you guys have traded Forex before, but most of the time you open a broker account, you put, whatever in there, $500, $1,000, and they'll match your deposit. They'll give you money to trade with and match your deposit, and give you this platform with all these tools and say, hey, go ahead, be a winner. And I think a lot of it is meant to distract you, honestly, because, now you have all these tools, and you think that you need to, figure out how to use this one and how to use this one and what this line means and what this line means and all that. And in reality, it's kind of pointless, because all of that stuff I mean, I could literally throw away all these tools and just look at what the price action is doing and come up with an idea of where we're going to go based on the emotional market cycle or the Elliott Wave cycle, which to me is just another representation of this cycle. Like this emotional market cycle is the Elliott Grand Wave. Okay, it is the Elliott Grand Wave, and we're going to see little waves within waves and be able to trade these things along the way, or just have a buy and a hold strategy. Like, I mean, literally, we could have bought Ethereum, XMR, ETC, Ripple, all of them when they broke their market cycle, and we noticed that a new grand wave was going to unfold, or a new emotional cycle, or a new market cycle was going to evolve out of that break. We could have bought all those coins 3 weeks ago and just held them, not even traded them. Literally, I mean, you can use this strategy, to be a long-term investor, trader, to trade swings on a 5-minute, to trade swings on a weekly. I mean, it's endless. I mean, once you understand the geometry of the market and how it's unfolding, you can use that information to trade however style you want to. Okay. When we see that these market cycles break and they create new ones, you kind of make up your mind what you want to do at that time. Do you want to trade the waves? Do you want to just buy and hold and just kind of forget about it for a while? We'll come back to Dash in a second, but I just want to show you an example here of Ethereum. Let's just use Ethereum for instance. Now, when Ethereum broke out, you could have easily just bought and held Ethereum for, let's say, a few months. All right. But when you trade that strategy, you have to have the patience and the discipline to ignore the intraday price. Okay. And, I basically developed my strategy by trading for years and losing, and then being introduced to cryptocurrency markets where I could have a little bit of influence on the altcoin markets in 2014 and kind of paint the charts a little bit myself, especially with a bot. And then went back to Forex and then kind of put all the pieces of the puzzle together, and then came back to cryptocurrency and really applied it more, if that makes sense. But what I noticed when I was trading foreign exchange is that when you see a cycle break, since you're trading on such high leverage, it's really hard to kind of get your seat for a longer ride. Meaning that I tried that long-term strategy in foreign exchange, and you have to be very, very exact and very patient, because in foreign exchange, if you see a move breaking in a new cycle or a new Elliott Wave set happening, if you buy right there and you decide that you want to hold it for a long term, you may have a day that you're up 150%, and if you don't take that profit, you come back another 2 days later and you're back at like 10% profit, or maybe even you're stopped out at break even, or even you didn't move your stop and you got stopped out or liquidated because the price came back around. So there's so much swing and fluctuation in the price there when you're trading high leverage markets, that I wouldn't really recommend using this strategy in foreign exchange for long-term swings, because you're going to have days that you'll spot a market cycle breaking or a new Elliott Wave formation happening, and you'll get in the market, and then if you don't take your profit at the top of that wave or that swing, your profit will be gone the next day. And that's kind of how I started trading the waves, the actual, instead of looking at something break here and waiting for, this, 2 wave to turn into a 3, a 4, or 5 all the way up, I started, trading these little inner swings and these little inner swings, because I was having times where I would get in here and I would watch the price, come all the way up to here and not understand the Elliott Wave cycle, and then maybe it would retrace, 61, 78%, and I would lose all that profit and kind of get confused and maybe sell at a loss or take my profit, kind of just tell myself, oh, I had all that profit here and I didn't take it, so I better take it here, kind of a mentality. And then the price turns right back around and continues to go. So understanding the way that the market's going to flow first, and understand this emotional cycle. First of all, it's going to stop you from having, bad trades from the beginning. Just understanding the way that the market is moving will help you to, not take trades at the wrong time, and understand when you should cut your losses short or let your winners ride, if that makes sense. So this is all unfolding as a result of an impulsive move that's measurable with a Fibonacci growth spiral. And so this whole thing is going to play out, and it's going to get mapped like this. It's kind of like saying, hey, we just made a move. This is our end destination, and this is our map to get there. Okay, and then we're going to use all of the other indicators and tools to give us confluence along the way. Give us confluence along the way, like support and resistance, the Ichimoku cloud, how it relates to where the price action is, different time frames, stochastic RSI strength, and stuff like that. Actually reading the candles and giving, a little bit of confluence to how the price action seems to be relating to the direction we think it's going. So everything else to me, I just use as confluence. I just really trade one thing only, which is the emotional cycle and how that is going to unfold through the Elliott Wave geometry, in a sense. It's going to be able to be mapped out like this. So we have a couple different ways, that we could trade that. But it's the same thing. Like, we want to apply the same strategy on every time frame. That's why I was talking about how we want to be able to identify Elliott waves in every time frame so that we can understand the potential, the potential trades in that time frame. So it kind of gets it can be a little confusing until you get practice with it and you know what you're kind of looking for. And for instance, let's use XMR is a really beautiful example here of wave within wave theory. Okay, let's look at it on the hourly. All right. Now we have here a large, let's get rid of this for a second. We have a large market move that was made, okay? And we can, we can plot this out. We can start looking at this thing on like a higher time frame before it happened, or as we were expecting it to happen, actually, because we were looking at this for a while before it happened. And this is, how you would identify this. Like this thing had a pretty long downtrend in here. Okay, basically, right around here. And it lasted a couple months, like 70 days about of downtrend. So this thing wasn't going up until it broke this line. Okay, it's the same story as everything. You have to break resistance to continue on. So this didn't, wasn't doing anything except going down until it broke that line. So basically right here on that 3-day where we get this 3-day wick right here, that's basically where the price broke out. It broke out in this 3-day candle right here. But the next 3-day candle opened and basically tagged the breakout line here and then pushed right through that 3-day cloud and continued on. So now we have a new impulsive move, okay? New impulsive move that basically I'm going to say is measurable from this blue line because that's where that 3-day candle opened and we pushed away from this resistance line. So now we look on like, lower time frames. What did we get out of that move? Okay. Well, actually, let's start at the 3-day again and work our way back in. Just real quick. So this entire move that happened here, okay? If you were just coming to the chart now and you hadn't traded this market before and you were looking for a place to enter Monero and you were saying, okay, how does the chart look on a higher time frame? You could start looking at it like this and saying, okay, there's a larger move that happened in the market, basically from here to here. And now it retraced, basically almost tagged the 61% here. And now it's kind of working its way out where it seems like it's held a retracement here in this relative area. Okay, so when we're looking at it on a 3-day, we kind of look at this like, hey, this could be a 1 and a 2 move. This could possibly be a 2-point of a larger Elliott wave unfolding. Okay, this could easily be a 2-point right around here. The basic, whether it was here that it bounced or here that it bounced, you know, we're just looking for that reversal point to hold a retracement of the impulsive move and continue on. Now we can get into the specifics of that, of where it bounced, if we really look at, like, you know, what are we looking at, the 3-day? Yeah. If we really look at like the open and close price. Open and close price tells us, all right, we basically have respected a 50% retracement so far. Okay. The open and close, the line chart doesn't tell us any expansions in price. It's just kind of like the core of the price action, you know, like the open and close price during that time frame. So I'll use that a lot to refer to see, all right, well, even though we had expansions in price and we had some selling down, you know, close to the 61, the real true market strength has kind of respected this, you know, this area of the 51%. And now on our 3-day, this blue line right here, this is our EMA, our moving average exponential. So this is telling us that the moving average here is actually, you know, caught up to us here. So, you know, that's also a pretty good sign here that we, you know, our moving average isn't down here and our price is trying to fall to it. Like, they're catching up with each other at this point. So we have a pretty good indication here that this thing is kind of holding a retracement here on a higher time frame. If it holds a retracement here and continues on, then, you know, on a bigger picture, we may very well be getting a 1 and a 2 move for a continuation. So now let's look at that whole 1 and a 2 move and see on a lower time frame, what is it? Like, what did we get out of that? Okay. So let's scroll back in here. Sorry guys, it's taking a minute here to scroll it all back in. Okay, let me get rid of the Fibonacci now, just to get it out of our way. Now let's look at this individual move that we had. Okay. Now, Monero painted the classic textbook example of wave within wave theory. Okay. Now, the only other explanation there's two explanations for how this could happen in that way. One is that someone programmed a bot to maintain certain ratios in price and structure based on Fibonacci numbers, which is not unlikely. I mean, I actually have a bot that I used on Bittrex in 2014 that was programmed to paint the market and kind of pump. It was like a pump bot. It was programmed to paint Elliott waves. Okay, so it's not that hard to put in decimal ratios according to the Fibonacci numbers of the kind of structure in the market you would want to maintain. But now we're talking, like, you know, these are hundreds of millions of dollars of money in these markets now. So either someone's doing that with a very highly sophisticated bot and a lot of money behind it, or it's the same thing that we're seeing in nature. You know what I mean? Like, when I program my bot to do that, or not me, I'm not a programmer, when I had it made to do that, it was based off mimicking nature. I basically took a market that already had an Elliott wave formation and a pump and copied the ratios and, you know, put those plots into the bot. So it's not unlikely, but it's not that it wasn't created from my mind or from the bot. It was mimicking a market that had already happened and a natural cycle that already happened. So yes, it's possible that people could be doing that, but when you see it play out over and over and over and over again, it just seems like it's actually just nature, you know. And that's why I see I put the pieces of the puzzle together, that it's just the emotional cycle, because we're talking about something where 90% of people lose in all financial markets. Like, I mean, I don't know if they've done a recent survey again, but, you know, for years it's been a constant, you know, pretty well known that 90% of people that embark on this journey to trade lose. So how are those people losing? Why are they losing? And what's that key factor all the time that makes them continue to lose? So that's how I started to research into my strategy of, why was I losing? Why is everybody else losing? And how are people winning? So to understand how to win, I had to study how I was losing and how everybody else was losing. And so it made sense. This is how everybody's losing, by not understanding how the market's going to unfold and exercising the wrong emotions at the wrong time. And not respecting the harmonious flow of nature and the market with Fibonacci. So I started putting all those pieces together and realizing that, you know, even though we may see something here that may be manufactured by, you know, an algorithm or someone with a bot, it's just a copy of what's in nature, and it flows so well that all the rest of the traders are going to lose according to that plan, you know. So whether it's, you know, someone running a bot or it's just natural, at this point I don't even question, because when I programmed my bot, it was, you know, it was just painting the chart, and the rest of the herd would follow the predictions that, you know, I was expecting, because it was all based on Fibonacci numbers, if that makes sense. So it just kind of like one led into the other. So what we have going on here now is just a beautiful, beautiful Elliott wave here. Okay, and when you're playing the Elliott wave strategy, you will come up with your own way that you want to trade it. Okay, like now, like I was saying, in foreign exchange, you may not want to trade it the same way that you can in cryptocurrency, because, like, for instance, like if you get in here on this wave here, 2, or you even get in here on this wave 4. Now, after that wave completes here, if you're trading foreign exchange and you got in here on a 4 point, you know, this retracement right in here, that even though this was a flat retracement of 38%, I mean, if you have a situation where it retraces 50%, boom, you're back here at break even and you're not making any money if you didn't take your money off the table. If you can make it through that struggle and that time, then you can understand there's a bigger move coming. But you have to make it through that time. Like, you literally have to be able to look at your balance and say, awesome, I'm up 150%, and then look at your balance the next day and say, awesome, I'm up 30%. And, you know, like, so if you can deal with that, like being up huge one day and then, you know, down the next day, but thinking of the bigger picture unfolding, then you can play that strategy. But for me, you know, I started just, you know, I got trained to take my profit off the table when it was there, because I was missing out on so much profit in foreign exchange by trying to play larger moves, that I just decided to play the wave strategy. You know, like if I see a wave moving and I feel like, you know, I can get, you know, whatever, like 30 to 40% out of it, something like that. This was only like 20% or something. But if I feel like I can get, you know, a good percentage out of it, then I'll go in, you know, with a large amount of capital if there's a good volume, and I'll try to just pull, you know, 20, 30, 40% off of that wave, cash out, and wait to re-enter. So you can use the strategy however you get comfortable with, but if you're going to play it in foreign exchange, you might want to, especially on leverage, take your profit wedge there and look for another re-entry. But if you're playing, you know, spot holdings on coins like this, there's nothing wrong with buying a big bag full of this when you see that it's, you know, breaking a market cycle, and then just waiting a couple months. I mean, something like Ethereum and XEM and a lot of these coins, if you look at their stochastic RSI on the monthly, there's so much room to grow in this market cycle. So buying and holding strategy for those larger altcoins could really work out in the long run, you know. So what we want to do when we see the market break, like we saw it break this line, okay, let's basically, we're going to paint that line red because that was our resistance line from the last downtrend, and we broke it. So we started breaking it here with this impulsive move right here, where this volume came in right here, this first impulsive move that held a 50% retracement and basically bounced off of that resistance line, and then impulsed again into a subminute wave. Basically what we see right here is this subminute wave right here. So when the market's unfolding and you see that first initial impulse, when you're trading it in its relative time frame, it's going to look, you know, different than it does after it plays itself out. Sorry, let me drag the chart here for some reason. Okay, so when we played this move looked different in its relative time frame. Like, we were looking at the chart like this, you know, not knowing what to expect after. The market made an impulsive move here that we could measure to get in, or even measure to get in here. So this is where, using Fibonacci with Elliott waves is going to give you all the answers to the pieces of the puzzle, honestly. So that's why my biggest thing is, when you see something break out, don't chase it. Just wait. Wait for it to retrace. Don't fall prey to that emotion of fear of missing out, because my biggest thing is if I can tell that the market is going up, I don't buy it when it's going up. So that's just, just even practicing that strategy will lead you into looking for the retracements of the impulsive moves. So if I see the market is going up and I say, boom, all right, Monero broke this red line, broke its market structure. It seems like it's, stabilizing here on the breakout line. Well, how does that look for entry? You put your Fibonacci tool in there. Measure that move. What does that tell you? Well, if we can zoom in here, get all the other stuff out of the way, it's showing us here that that's about 50% retracement right there. And it actually was a wick, wicked right off of this downtrend line and right off of this 50% retracement line. Okay, let's get this blue line out of the way. This blue line was just telling us where the 3-day pushed off of the resistance line, which is actually this point right here. So when you see the first impulsive move, don't chase it. If you see the market is going up, do not buy the market when it's going up, because impatience is never rewarded in trading. So that's the first rule there. Don't be, the ones that say, oh, this is a larger cycle, so but this is what's playing out in the smaller time frames, even, like this emotional cycle. So don't be the one that sees it really rallying out and says, oh, I have to chase this. I mean, yeah, you could have seen it rallying right here and said, oh, wow, this is breaking out, and buy it. But the amount of times that you could exercise that strategy compared to not are very limited. You literally have to get the coin or get the market as it's breaking out from accumulation, or, doing that bounce and see this large volume come in and get it. But understand that it's going to retrace and pull back, and that's the beginning of an impulsive move. Okay, so I usually just don't even, unless the time is, it really depends on the timing. Like if you roll up to the charts and you're looking for a trade and you see something like this breaking out here and it's heading for your downtrend resistance line, buy it. Like that, that's one of the few times that I would buy it as it's going up. But most of the time when you see things going up, it's too late. Like unless you're really, most of us aren't watching the charts as things are breaking out. I mean, that does happen if you're like day trading and looking for moves to make that way. But with my strategy, and especially sending signals out on the market moves, I usually don't take a trade or send a signal on a trade that I can't really spot coming for. Like, I want to be able to spot a move happening a few hours at least before it happens. And as many of you guys that have been on my list for a while, you guys probably noticed that, I spot moves happening in the market weeks even before they're happening. So you got to come to a balance in your own time frame of how you put this information to use. Like we saw Ripple breaking out at 500, 530, and we took action on it by accumulating some at that price, but it didn't come to fruition for 2.5, 3 weeks. So we're kind of spotting things early. So using this strategy, I really like to not take a trade unless I can see that it's coming for a couple hours at least in advance, or a rare situation where you sit down at the charts and you're kind of scanning through, and then all of a sudden you see something like this. Oh wow, this is really breaking out, and it looks like there's a lot of volume coming in, and we're heading for that resistance line. Sure, let me buy some here under the resistance. But the chances of you you're going to be scanning through the charts and looking for trade opportunities more to plot them out for the future, more than you'll be sitting down and just trading something as it happens. So I would save the buying it as it's moving strategy only if you see it happening in the time. And it has to be at the right place that you see it happening. Because if you see it happening here, then it's too late. If you see this happening here on this breakout and you buy it while it's moving up, it's too late. So, if you hopefully you guys understand what I'm saying. Like most of the time when you're looking for trades, they're not happening right as you look at the chart. You know, if you find a situation that is happening, then yeah, look at it from the bigger picture. Oh, okay, what could this be leading to? And maybe make your decision to get into a market like here or something. But mostly all the time when the market creates a new impulse, it's going to create an Elliott wave. I mean, it's pretty, and in cryptocurrency, even more so, guys. I mean, the reason I found that this emotional cycle here plays out in cryptocurrency more than any other market is a combination of two main factors: more dumb money and limited supply of coins. So we're seeing these market bubbles and these, wave within waves forming so beautifully because it's the emotional cycle is so relevant. It's playing out so wonderfully because mostly everybody that's trading cryptocurrency has absolutely no training or trading experience. It's a gambler's mentality. It's a gambler's game. Like a lot of, I mean, you can just kind of get the feeling if you go in Poloniex and you go in the chat box, or not even go in there, just read what people are talking about in there. It's kind of like, people going to the horse races and looking and saying, okay, which horse should I put my money on today? Which one's moving? So when you have that kind of a crowd mentality, it's really leading to these Elliott waves painting themselves so beautifully because it's just dumb money that doesn't understand the cycle of how things are going to unfold according to natural law of Fibonacci and unseen sciences. I mean, Fibonacci to me, like I was saying to by one guy the other day, like this is not rocket science, but it is kind of sacred science in a sense because there's unseen energies at work here with Fibonacci that are undeniable. And the fact that the ancient people, I mean, I don't know, this is kind of how I relate it. And that's what brought me, into understanding and trading even more, because I was explaining to you guys in the last one with Fibonacci that all my other studies of life and sacred sciences and mystical things in creation led me to the Fibonacci ratio. And even ancient aliens, on the History Channel, that stuff is, a lot of it is based in a lot of mystery, because ancient people had knowledge to build megalithic structures that we don't have today. We cannot duplicate the way that they built that today. So there was some sort of an unseen knowledge or some sort of knowledge that ancient people had that we kind of lost with our modern civilization. And so if ancient people built things that we can't explain now, and they had knowledge of mathematics and the universe and stars and all sorts of things that we don't really have today, then there's something that's missing from our modern culture. There's a knowledge, there's some sort of a unseen energy and knowledge that's missing from our modern society. So if ancient people were using the Fibonacci, the harmonics and the flow of the Fibonacci ratio to put into their ancient structures and their art and all these things to harness that power, there was a power to that they were tapping into. They were doing that because there was some sort of power in that they were tapping into. And now that we're using that as a kind of our main kind of factor in the market, and it's giving us, I mean, it's powerful, man. I mean, it really is, because like I said, I really think that the answer to all of this is Fibonacci. That Fibonacci growth spiral, and I don't really use it that much on the market because I want to be more precise with targets, and I use the Fib retracements and extensions. But that spiral is everything. That spiral is everything. It tells you how things could grow. And so if ancient people are putting this in their art, in their structures, and to harness some sort of an unseen power and unseen energy, then we better respect it when we look at it in the markets, because the markets are just an expression of human emotions. Every single one of these candles here that gets painted on the chart is a remnant that's left behind of a print of human emotion. All the the buying that went in here, and all the fear of missing out, and all the greed, and then all the fear of the loss, and the anxiety that was felt here, and then all the strength and people wanting to get into it again. I mean, all of this unfolds because of human emotion. And so if everything in our universe can be measured with Fibonacci, why not the print of human emotion, right? So it's a very powerful thing, and all of these moves that happen along the way can all be measured with Fibonacci, meaning that this first initial impulse, we can get a Fibonacci retracement entry on it. Sorry, I just faded out for a second there. That first initial impulse, we can get a Fibonacci retracement entry on it. And that first initial impulse, we can get a Fibonacci extension of an idea of where our target would be. So those initial impulses tell us a lot. Tell us a lot about how the market's going to unfold. And in reality, all we're doing is measuring the print left behind by human emotions, really. And so that's why it works, because the only thing consistent in all these markets is the emotions of the traders, is the mistakes made by the 90%. So, and because money's a very powerful thing, like people make very uneducated decisions when it comes to money. I don't know why, but for some reason people do. And we're seeing the reflection of that in the market. So what we want to do is we want to wait and let the market do what it's going to do. We want to say, hey, look, Monero broke a market cycle, had a very impulsive little move here. This little move here is leading to something else. Do we know what that's leading to just yet? No, but it's probably going to lead to another huge market bubble, especially with this volume and this momentum around. Okay, so we can say, well, once we broke that downtrend, and we're getting a new market cycle, a new market bubble that's going to come out of that. So how's that going to unfold? Well, we don't really know what it's going to look like until most of it gets painted on the chart. So we just know that that's going to unfold as waves within waves. Okay? How do you use the Fib spiral tool? High to previous low. Let me look at that question. How to use that Fib spiral tool? High to previous low. And does that give you a time reference on level? It depends on which wave you're measuring. Yeah, you would take it from high to previous low, exactly. And then it kind of gives you a roundabout, kind of, if that makes sense. Like when I put the Fibonacci spiral in there, it's going to give me like a roundabout idea of where this could grow to. But when you put your extensions on there, it kind of gives you more like price points along the way. Like if I put extensions on here, it's giving me price points along the way that this, could manifest itself to. Whereas this one only led to here, but this was only the sub-minute wave that we were measuring with that. So, I'm sorry, I didn't understand that question. No, it doesn't give you a time. No. I mean, time is kind of something that you have to figure out with the stochastic RSI strength. I think is kind of like the best reference to how, or like when you see that this move breaks out, you can look on like a higher time frame, or like a monthly, and see how strong you are to see how far like that grand wave may go. But there's not really like a time. It's really hard to get time exact on a lot of these moves, because the factors are of like, when something impulses like this, it's showing us, okay, this could grow to a certain potential level, but we don't know how long it's going to take to get there, because we don't know when the money's going to come in, when who's going to buy what, if that makes sense. We just know that it's possible that it could expand to that level. And then we kind of just reference our stochastic RSI strength in different time frames to say maybe this could happen, within this next month or within these next couple days, that kind of a thing. But we'll talk about reading market strength with the oscillating indicators. No, I'm not sure if it's the next one, but soon. So we understand that when the market breaks out, though, that's going to paint some sort of some sort of Elliott wave. Okay, and we want to get that first initial impulse. Okay, if we can't get it here, we want to get it on the number 4. And so number 4 is where a lot of us got into Monero the first time. And we got into it understanding that there was a larger move coming, but we didn't really know what that move was going to be until it painted itself. Meaning that we understood that we were getting in on a number 2 or a number 4 point. But at that time, we didn't know that it was just a sub-minute wave. Which makes sense because, when you think about it, okay, this is a start of a market cycle. So the start has to start somewhere. And the very beginning starts with that sub-minute impulsive wave. And then that one is going to retrace. And then that entire move... Sorry guys, my internet's fading again. That entire move creates a 1 and a 2 as well. So we don't know, when we're playing the Elliott waves, especially in the bullish market, we don't know how exactly the retracement part is going to show itself. We know pretty well that the impulsive side is going to be, staircase up. And there's certain rules that should abide by with the Elliott Wave Theory, meaning that this first impulsive move up, that second point, let's just get rid of this wave, do another one. This, we want to map out the price as it's moving, but understand that it should respect certain things of the Elliott Wave Theory, meaning that if we see an impulse in the market, we know that the second wave should not retrace 100% of the first. If it retraces 100%, it's not an Elliott wave. It's not going to, most likely not going to lead into an Elliott wave formation. Okay, so we know that rule number 1, that 2 should not retrace 100% of 1. We also know that 3 can't be the shortest. So 3 is usually always a little bit longer or equal length to 1. So we understand that third leg should be at least the length of 1, and it can't be the smallest. And then we understand that when we get this retracement of wave 4 here, that it should not infiltrate the price zone of wave 1. Now, it can tag it, it can, grind out there for a while, it can come all the way down and overlap it, but open and close price for that time, or not, like let's say a higher time frame, should respect it. So that's how you can kind of after you see a wave 3 happen, you can kind of try to buy that sell-off of that wave 4 and kind of try to get it around the top of wave 1. So we know there, with 3 rules of Elliott waves, that wave 2 should not retrace 100% of wave 1. Wave 3 should be at least the length of wave 1, if not longer. And wave 4 should not retrace into wave 1 height. So right there we got the respect of all the Elliott wave formation, and that's actually how we got our entry on here, 125, because I missed this point here when I was looking at the charts, and I saw this impulsive leg 3 and said, well, let me wait for it to dump down and buy and get everybody in here at the top of this wave 1, which is the bottom of wave 4. So playing the rules of the Elliott waves will give you, a strategy of how you should look to enter that impulsive move. And then after that, you're going to get a consolidation or a retracement of the whole move, which is what we got here. This is basically all just a 1 and a 2, except this 2 wave was flat. It was only 38% retracement, and when you have a 38% retracement wave, it usually leads into a flag or a pennant, like a very shallow retrace. So that's what really that's all that a flag or a pennant is when you see it in the market. It's an impulsive move that retraces just a bit, maybe like 38%, and then after it retraces 38%, okay, just about 38%. So after it retraces 38% and it consolidates in the zone, it breaks out again. So that's what we have here. We had, an impulsive move that basically made a flag or a pennant. A pennant is when it comes into a triangle. A flag is more so when it's, kind of like, looks like a flag, So, you can have a flag be, and there's all sorts of ways that you could, flag up and pennant up. It could be, you know, broad like this, but you're getting points of reference by the highs and the lows in that consolidation. So when you have a flat retracement like this, or a shallow retracement of only 38%, the price rallies out of it and creates another impulsive leg. Now that impulsive leg is sometimes, or most of the time, the length of the pole, which is why that's called a measured move in trading. And that's one of the few moves that you can actually get away with being a pattern trader. Meaning that, you know, this created a flag, or basically created a flag right here. And then it broke out, and it ran just about the length of the pole. A little bit longer though, because we were expecting our wave 3 to be a little bit longer than wave 1. Okay, so, you know, pattern traders were expecting this thing to come out here or so, and we were expecting our wave 3 to be at least, you know, about that long, or maybe even a little bit longer. Okay, and that's what we get out of that one. Now, the thing with Elliott waves, you have 3 rules, which we just discussed. Okay, wave 2 cannot retrace 100% of wave 1. It has to fall anywhere in this area, you know, of basically 78.6, 61, 50, or 38 to make a flag or a pennant. So after you hold that retracement and you follow the first Elliott wave rule, you know, where you don't retrace 100%, you're going to get a retracement. You're going to get another leg out of that. Now that leg, the next rule, should be at least the length of 1, if not a little bit longer. Okay, and that next wave can come down and even test the top of this wave height, but shouldn't really infiltrate it. Shouldn't go down like here. You know, sometimes in cryptocurrency when there's panic, it might tag down that far, but it usually turns back around. And that's only tagging that far because people do not understand that they're literally panic selling in an oversold condition. So if you see something like that, usually in cryptocurrency, it usually bounces back up pretty quickly. But mostly it should respect the top of that wave and then get another 5th leg out of it. Now those are rules of Elliott waves, okay? Meaning that, that wave here, 2 should not retrace 100% of 1, 3 cannot be the shortest, and 4 should not really infiltrate wave 1. Okay, so those are actually like 3 golden rules that Elliott waves follow. They actually follow some actual strict rules. Then you have guidelines. And guidelines are generally where if you have one wave that is flat, now this doesn't happen every time, that's why it's a guideline, but when it happens, you know, it happens enough times that it's not a rule, but it, you know, it's a very well-known guideline within Elliott Wave Theory. That if you have one retracement that's flat, okay, like let's say this retracement that was, you know, basically turned into a pennant. So if you have a retracement that's like 38% or flat, you know, or shallow, however you want to call it, then that next retracement is going to be deep, okay? Meaning that if you have one retracement that was flat, that next one's probably going to be deep, and then a continuation on. And that's what we got here on Monero. Okay, we got that same guideline, you know, kind of mentality that played out here on Monero. Let's get rid of this wave real quick. Meaning that right here, this entire move was a 1, 2, 3, 4, 5 that led into a shallow 38% retracement. So this next move up that we got, and even in here, if we really look on like the smaller time frame, like right here, it's like a little 1, 2, 3, 4, and a 5. So that created a whole another leg up right here. That's our number 3. What happened with our number 4? Since our number 2 was flat, our number 4 came crashing all the way down. Now, it didn't really last here, but it did crash all the way down to test the top of that wave 1, right there. And then, boom, we got a wave 5 out of it that gave just a little bit more of a high, just a little bit higher of a price, right there. So that's our Elliott Wave impulsive leg right there, where it respected all the Elliott Wave rules, but also played out the guidelines, you know, like the general guidelines of Elliott Waves, that we had a flat retracement here. So this next retracement here was very sharp, very deep, and then it rallied out. Now, when you really look at it though, okay, let's just move this out of here for a second. and let's mark this price point right here. So if you understand Elliott Wave Theory and you realize that, we just made a wave 3 up and there's a wave 4 going to come crashing down, and that wave 4 should respect this price point, you can literally play this strategy where you want to buy anything that gets close to the top of this wave on this sell-off. Because you understand Elliott waves happen in 1, 2, 3, 4, 5. So as everybody's dumping it out here and thinks it's over and they panic, you're buying their panic. You're buying their fear. Because you understand there's another 5th wave to come out of it. Which is actually even probably going to lead into a larger wave structure. I mean, at that point, you're literally buying this little point right here. But in our Monero scenario, it came all the way down here and challenged the top of this little wave here. Oh, no, I'm sorry. Whoops. Sorry, that was the sub-minute. On Monero, we were buying this point here, but it was coming down to challenge the top of this wave 1. Okay, because these are our bigger waves, meaning that this is, in here is our sub-minute waves, 1, 2, 3, 4, 5, and then our sub-minute correction, and then, but this is our larger 1, 2, 3, 4, 5. So that would actually be like our red wave here. Okay, whereas this black one in here is more so these little sub-minute waves that we got our entry on in the beginning. So when you understand the way the Elliott waves are going to unfold, you can literally play that strategy where you're like, all right, we just had a 1 and a 2 move, we just had a nice impulsive 3, and now it's dumping. It's dumping down. All right, let me put some buys back in at the top of this wave right here and try to get that panic, try to get that fear. And if you really look, that was just a wick. I mean, if you look at the open and close price for that hour, the price didn't even come anywhere close to the box. I mean, literally. I mean, it stayed right, actually, at the price that it is right now. It stayed right here. Okay, and if we look here, let's go back to our candles. So look how much, you're basically getting the price on a sell-off, literally 13 to 15% higher than it actually even opened and closed. Okay, so that right there, that's why we buy the fear. We buy the price when it's going down because we understand it's going to go back up. So we only understand that though because we understand the geometry of the market. We understand that there's an emotional cycle that's playing out, and that once the spark happens in the market has the potential to grow to all those levels based on the Fibonacci ratio. And the way it's going to get there is waves within waves. Okay? So we understand now that we had an impulsive move in the market here. Whoops. Come on. Drag this back over. And this was basically our Elliott wave count right here for this wave set. Okay? But all that really did was give us a large blue 1 and a 2. Because remember, we just looked at this on like a 3-day, and it held a retracement right in this area. Okay, right in this area. Now so far, this thing's having a hard time clearing this hourly cloud, but we'll see. I don't really think this is going to dump down further, especially because the USD value is dragging it up. If you kind of look, we're actually trending up against the dollar here, actually holding a little bit of a trend up. So I kind of switched between the two to kind of get an idea of getting an idea of what the reflection of how one should be playing out according to the other. If that makes sense. So now out of this whole thing, okay, we got little sub-minute waves in here that we put Fibonacci retracements on to get our entries here, and now this whole thing has made an impulsive wave up, which really, once this thing turns around, should just give us a large 1 and a 2. Whether we put the plot on the hourly, we could maybe put the plot here. On the 3-day, we might just put it here because all these price points will merge together. And we're looking for another wave out of here. So all of this on the smaller time frame really just made up this, where we have sub-minute waves that led into a complete impulsive leg up that led into a larger correction. And we even see the correction here. Okay, when we see the correction here, we got 1, 2, 3, 4, 5 down, 1, 2, 3 up, 1, 2, 3, 4, 5 down again. Okay, and in here, this correction after this, now this is where we impulsed up. We impulsed up 1, 2, 3, 4, 5, and then we came down 1, 2, 3, 4, 5. Sorry guys, I don't know what's going on with my internet here. It just keeps fading in and out, but I don't lose you guys. But basically I have 1, 2, 3, 4, 5, and then here we have like a 1, 2, 3, and then here we have a 1, 2, 3, 4, 5. And then that whole thing, where did it wind up? At a 50% retracement, basically. Right here, from this entire move. Okay, so this entire move now, the 1, 2, 3, 4, 5, the sub-minute waves all led into one big leg up that did one big correction here. That when we look at it on a higher time frame now, it looks like we just did a bigger 1 and a 2. Okay, bigger 1 and 2 right here. Okay, so if we pull out of this, meaning that on our higher time frames, we're looking at something like this that just happened. And we're trying to turn this boat around and get another leg out of this, okay? Which would be our bigger wave 3 starting here, this blue wave. Okay, so when we look on the 3-day, we don't see any of the sub-minute waves anymore. We don't see the black waves, we don't see the red waves. All we see is the blue wave on the 3-day. Okay, all we see is that 1 and that 2. But when we look in depth, and break that apart on the smaller time frames, we see all of the waves within waves. We see, this entire thing playing out on the hourly. We see all the sub-minute waves, we see the red wave, and we see the blue wave as the result of what all that formed. So, flipping through the time frames and giving us an idea of what's possibly painting here, really puts all the pieces of the puzzle together. Like, I would be very surprised now if this thing dumps down further. Okay, like it's set itself up now to continue into a new market cycle. And what I really think that we're getting here, especially, wow, okay, now this is a nice sign, guys. When we start talking about the Ichimoku cloud, okay, this thing is just like trailed itself down until now it's actually hit some sort of support, okay? Hit some sort of support, and we're getting a 12-hour crossover here of strength. That's a really pretty good indication here that we're, finally getting some kind of, strength behind this market to turn it around and create a third wave out of this. So that's a really good sign that 12-hour cloud is getting ran into there. So I want to show you here, though, what I think that we're actually doing, okay, and how this is going to probably lead into something larger. Because, first of all, when we look at the emotional cycle, now this is just general markets. This is not, a chart that was made for cryptocurrency. This is just general markets, meaning that, we see disbelief here, and then we see disbelief here. Well, that's because it's a cycle that repeats itself. And as it repeats itself, this bubble that comes out of it is going to be bigger than this one. Okay? So that's why disbelief over here led into this bubble, but now disbelief here is already, up in this price zone, meaning that when this manifests over here, it's going to be bigger than this one. So that's just the general, way that things flow already in the markets. Now, when we talk about cryptocurrency, we're talking about completely different kind of a structured market where everything that we're trading has a limited supply. So there's that whole supply and demand factor, and the fact that cryptocurrency price is determined by market cap divided by available supply. So these cycles that repeat are going to be profoundly larger as more money comes into cryptocurrency, if that makes sense. And a real fine example of that, and we'll come back here to Monero in a second, but just to show you, a real fine example of that is, just by looking at the Bitcoin chart on Bitstamp on, let's say, the weekly. Okay. What do we have here? Well, we have one. Let's get rid of our drawing tools here. Okay. Okay, now what do we have here? Well, we have 3 market bubbles in a row, basically, is what we have. We got this one here. That was a complete market bubble in itself. Held a 78.6% retracement, basically right here. All the signs that it's breaking. Nice retracement held. Basically, you know, downtrend in this area broken. Now we're starting to continue up. So we have one cycle here that, you know, I'm sure over here, if we were looking higher at a smaller time frame, this would be like, wow, disbelief from that last rally. I mean, Bitcoin had another bubble before this that we don't see on this chart. You know, this is when Bitcoin went from $12 to $260. But, you know, before that, Bitcoin went from, you know, like, you know, nothing, a penny to 11 cents. And then it went to $1 and it was a huge thing. And then it went from $1 to $12 and it was a huge thing. So it's just like one bubble that leads into another. And the more market cap that comes into this and the more people that find out about it and trade it, the bigger it gets. Okay. So then this bubble led in. So there's like 3 other bubbles that led to this bubble, first of all, that we don't even see anymore. They're just flat lines and irrelevant price action now. Now here, we do see this $12 to $260 bubble, but we only see it on Bitstamp. We don't see it on Bitfinex. We don't see it on any of the other exchanges that have, you know, Bitstamp's kind of like the oldest now for chart history that we can get. We would have to look at like Mt. Gox charts for the previous bubbles, and I've actually had a really hard time finding those charts. So if anybody has a link to those charts, please, you know, let me know. But we had this bubble that were measurable, okay? And then once this bubble, I'm sure that when we let out of the previous bubble, when we hit about here, we were hitting this disbelief. Like, what? I can't believe that Bitcoin's rallying again. It's up over $12 again. And then bang, it goes to $260. Then it comes back down. Okay, but this time, you know, it doesn't do the whole, you know, 100% retrace, or, you know, this is actually not 100% retrace. You have to understand that this cycle started lower here in like the depression phase that they don't show here. So what we're actually seeing would probably be, you know, a 78 or 88% retracement at this point. But Bitcoin, market cycle, held the retracement, broke the downtrend, boom, another market cycle came. Okay? And after that market cycle came, and it did the whole, you know, usual emotions of the market cycle, meaning, you know, by the time that we get up here, the thrill and the euphoria kick in, and by the time that we're about here, we're complacent. Okay? Thrill, euphoria, complacency, and then as it bleeds all the way down, we get all the anxiety, denial, panic, just get me out of this market, and everybody's mad because they just lost all their money. So that's what goes on here. And then out of that comes another one. And Bitcoin, now, it's like this. Bitcoin is kind of like at this point in its market cycle, right about here. Meaning that if we were to look at this bubble and forget about where we're at now, if we were to look at this back when it happened, Bitcoin is kind of like, you know, at this point where, you know, we would have to look at a lower time frame to see the kind of waves that we're seeing, because as things get bigger, they kind of take longer, if that makes sense. So this bubble happened faster than the next bubble, you know, and then this next bubble took longer, and this next bubble's taking longer, and the waves are getting bigger. So right now, Bitcoin is about this point of where this market cycle was, where we rallied all the way back up, and then we broke a new all-time high, and then we continued to rally. So, but what happens in the market to create that bubble is what we're seeing go on with Bitcoin right now. Like, and you really think about it, if you really think about the emotions that are felt and how this really applies, just think about this for a second. Okay, a whole downtrend market cycle, and then when something breaks out and it rallies all the way up like this, what does it do? It leaves the market in disbelief. Think about Ripple right now. Ripple broke a long downtrend and then just bang, went all the way up to like 7,000, went from 500 down here. And what did it do? it left everybody in disbelief. It broke its market cycle, and the first thing it did was paint disbelief in the market. So Ripple's kind of here at the disbelief part. Now Bitcoin, in its market cycle, is all the way up here. So Bitcoin is right about here. Right about here, where we've kind of ramped up this whole year, basically over a year, and now we've tried to sell down under 1,000 several times, to where Bitcoin has become defiant of that sub 1,000 price. And so what happens in the market and in the consciousness collectively of society, and what brings bubbles to happen and manifest, is that if Bitcoin keeps creeping up here, keeps creeping up, by the time it hits about here, what happens? Everybody starts to get optimistic again about Bitcoin. Oh wow, this isn't going down. Wow, it's really respected 1,000. It didn't dump below 1,000. Wow, it's back over 1,200. Then what happens when it gets up to about 1,500? Everybody starts to believe, wow, this is really going up. Wow, I better buy some of this. I better tell all my friends. Then it keeps going up, and then the thrill comes, and everybody, wow, this is really going up. I'm going to remortgage my house and go all in on margin, and I'm going to tell everybody about it. This is the best investment ever. And by the time it's up here, it's all over the news, and the news is now saying how Bitcoin has been the best performing asset of the year and of all time, and and then all of a sudden, so the financial analysts on the news are not your friends. Like, I don't know if they're just hire the stupidest people to give you financial advice, but it's usually always the opposite of the herd. And it makes sense, like you need to do the opposite of the herd to gain in these financial markets. Okay, so as Bitcoin's pushing its way back up here, if it clears 1,200 again and holds, it'll create optimism. And then after that, if it continues, it'll create belief, thrill, and euphoria. And those are the emotions that'll push us higher. Okay, but that whole thing unfolds as waves within waves. And now all of these coins, not all of them, but a majority of these coins are getting new market cycles now. So, and a lot of them have had market cycles in the past, but they're just getting, fresh new ones. And so when we look at XMR again, we see a picture unfolding here, okay, where we had a market cycle over here. And when this market cycle took off, it just, it broke a downtrend. This is kind of like Dash. Like Dash did the same thing, where it had all this previous price action in this area before. All of this action was, for a couple years, some previous price action. And if we zoom into that box and, scale it up and look at the trades that happened in that time frame, I mean, those were like, 100% moves. Like from here to here was like 150%, and then this move here was like another 100 and some percent. Like those were like 2014, like when we were calling this like pump and dumps and stuff like that. But it was really price discovery. All this thing was pumping and dumping all for a couple of years, but it was just price discovery until it left the price discovery box, which is what Dash did. Dash literally mimicked this right here, and which I found very interesting to consult. Like, I don't know if you guys know this or not, but I got all of my targets for Dash off of the market structure of Monero, because Dash duplicated this structure of Monero. I mean, if you guys dig back through my Twitter and even one of my videos that I made, the thumbnail for the video shows this right here. Shows this right here, with Dash just sticking its head out just a little bit of green, without all of the Elliott Wave yet. Just kind of like a hint, letting people, I mean, we're discovering the keys to the golden kingdom here, guys. Honestly, like this strategy is very profitable. And when I researched Elliott Wave Theory, when I started putting it together, not many people talk about it because not many people understand it. But when you really dig into like the big investment firms and stuff, like the people in the back offices that are well respected that have the answers are Ellioticians. They're people that understand market cycles and Elliott waves. So we're on to something here. Okay, there's no doubt about it. We're onto something here, and I'm sure all of your guys' accounts are reflecting that. So, because we are figuring out the structure of the market here. So when this market cycle happened, we got a nice move here. Nice move. But what was that move? Well, it was just a 1 and a 2. I mean, on a larger time frame, it's just a 1 and a 2. All we had here was just a 1 and a 2. And when it held, it led to the 3, 4, and 5. Bang. Now, that played itself out on a 12-hour time frame, relevant to this market cycle. Okay. Now, if we look at this market move right here, okay, if we look at this market move and we pretend that we're playing that market move, okay, like, you know, we want to map it out and see how we could have seen the rest of this coming. Well, we can literally say, now for me, first of all, when I do Fibonacci's, I usually will go from the breakout. Now you can go from the low of the market. It'll just give you a different reading. But I will usually go from where I saw the market change, from where I saw the volume come in, from where I saw it broke a new level and started a new impulsive action. And so for me, that would be basically right around this line where we broke out. And for Dash, it's the same thing. I'm taking the breakout line, not the bottom of the market from my measuring. So, which I don't know, like, you know, I've had people tell me in the past that that's wrong, you're not using Fibonacci right, and I'm just like, whatever, you know, like, I use it the way I use it, and it works, and I make money from it, so that's the way I do it. But basically, I take the breakout. I will not take the bottom of the market, because that's going to give you a different reading that maybe you could trade off of. But to me, this is true. Like, this is where the money came in, and the money that came in is going to try to maintain this retracement of the money that went in here, not down here, because you very well could have had a big whale that bought a huge amount of this on the breakout and said boom, and they're not going to try to protect their price based on previous price action. They're going to protect their price based on where they put their money in. That makes sense. So that move right there is measurable, basically 50%, more or less, almost 61. Let's see, basically 50%. I bet you if we look at the open and close, not even 50%. Look at that, 38. Okay, pretty bullish. So that move led into when this was being played out here on a smaller time frame. I'm sure not many people thought that when it sold down here, it was going to continue up and make a larger market structure. So what this is doing, though, as we pointed out on Bitcoin, one market cycle that leads into another leads into a bigger market cycle. So this first impulsive wave here that we got for Monero on this market cycle showed itself to be about this big on a 12-hour chart. But now we're making a new market cycle. So I am under the impression that we very well may have just made a 1 and a 2, but now it's bigger. It's bigger because we are making a bigger market cycle, because these market cycles, as they go, they get bigger. So meaning that, when we look at Bitcoin as the example, the first bubble that we saw, well, now it's all scrunched down like this and we can hardly even see it. So what this is setting itself up to do is do the same thing it did here. Except now on a higher level, on a bigger time frame. Okay? Something like this. Now, how long will it take for that to happen? Don't know. We'll have to get into reading our strength oscillations and our indicators of strength and supply and demand and stuff like that to get an idea when we talk about that later. But we get an idea of where it could go based on this. Based on that. So this emotional bubble here is leading us to extensions in price that this one could go to. Okay, And it shows us that this one could actually go all the way to here. all the way to here. By the time that it's done and reaches this point right here and then starts to break down, it could literally get all the way up to here. Which makes sense because even though we just experienced this whole thing with Monero, you have to think about how waves within waves unfold. When we were playing this sub-minute set right here, we had no idea at 175 or 125 that we were getting in that we would be looking at that move really scrunched down and on a higher time frame. Like literally right now, we don't even if we go like this, we don't even see that sub-minute move. I mean, it's just in here somewhere. In here somewhere. We don't even see it. So all of these little waves within waves are painting into bigger waves that are creating a bigger market structure. And we want to tune into that. We want to tune into that and have a strategy to play it. Whether we play it waves within waves, or like I said, you just see it breaking here and you say, oh, wow, this market cycle should be bigger than the last. Let me buy it and just hold it until we start to get up into these levels. Whether it's, 2 months from now, 3 months from now, 6 months from now, we don't know. We don't know. But we do start to get an idea once it paints the first wave. Okay, and that's kind of like where we're at right now. Meaning that I'm pretty sure that both Ethereum and Monero just painted, and possibly even Dash, just painted a 1 and a 2 of a larger wave set that's unfolding. So now that that's done that, and it seems like it could turn around. And now this is looking really actually pretty bullish to me right now, the more I look at this, because I see a lot of support growing here. We really have tried to dump under that 50% line several times, and we have not done it. We're resetting our oscillations of strength. We're resetting them on higher time frames. We basically are getting a 12-hour crossover now. I bet you we're probably even getting a daily. I know we're getting a daily one on Ethereum. Okay, yes, we're getting a daily cross here. I think so. Yes, okay. It is looking like it wants to grow now. Now, we're going to talk about the stochastic RSI and oscillating indicators, but just to briefly touch, upon it real quick. Up here, maximum strength, even considered overbought. Down here, weakest market strength, oversold. Okay, just to kind of give you a quick idea. So, meaning that we've been oversold here. Basically, since we held that 50% retracement right here, this market on the daily has been down here in the weakest conditions it could be. Okay, so once this market starts to get strength behind it and grow, and it holds this retracement, that's the kind of thing that we're looking for to pull a third wave out of here. We're looking for it to gather enough strength and grind through here to bang and get that market strength behind it. Get the strength of the daily, the 3-day, the market to give us a big push. So we can kind of use the oscillating indicators to tell us, how much strength and when that might be coming. But now that this market made its move here and we can measure it, like I really feel like we just got this type of a move over here, but just larger, okay? Because it's a larger market cycle. So now that we got that, we can measure it, okay? And we can get a little bit better of a time frame and say, okay, this wave here from impulse to impulse again, let's just say it's going to impulse, let's say, start impulsing today or tomorrow. We got about 27 days, about a month almost. So let's just say around about a month from impulse to impulse, meaning that the impulse happened and then the correction happened, and by the time we got another impulse, it took a month. So that can kind of give us a relative time frame of what we may expect for the next wave. Because things are kind of uniform like that, meaning that if we check historic price and kind of go off of the same thing, it does flow. It does flow. So we can say here in the past one, from impulse to impulse again, it took 6-7 days. Let's say a week. Okay, and then from here, from impulse until impulse again, it took 7 days. So it's kind of laying, and then let's say this one, let's see what it did. Basically from impulse to when it was done was about, this one, the last wave was a little shorter. about 4 or 5 days the most. 3 days to actually get out the top. So it gives you a little bit of an idea now that this wave has painted itself, what we may expect here coming forward, coming after this, what we may expect. So if this pulls out of here and starts to rally up, we got 2 indications from it based on Elliott Wave Theory. Number 1, that the next wave coming should be at least, let's just make it green because it's going up. This next wave coming should be at least this length, at least that length. So let's just do some simpleness like this thing. So we're at least looking for this price point on this next wave, at least. And wave 3 might even be a little bit longer, So now let's get a little bit of an idea and say, well, okay, well, based on the extensions in price, what's a good price point for that next wave to hit? Bang. The 1.272 of this first emotional wave. So, meaning that this was a little bit smaller, and it was the length of this wave, right about here. So now I'm expecting this next wave to be at least that long, and it seems like a pretty good likely target for that wave would be the 1.272 of the extension of this wave. So that's where I'm going to put my target. I'm actually holding this. I got it down here at 165 at that 50% of the sell-off, and I've just been patiently waiting for this third wave to manifest. Now I'll probably add to my position when I see some sign that we broke out, which is basically this right here. How we're got this. It's the same thing. We're creating the falling wedge in a sense on like a higher time frame. So when we see price, on like the daily start to pop out of here and start to, grow right here, that's a really, clear indication that this larger move held a retracement and we're going to get another leg out of it. And so when I see, so I'm kind of buying here on the 50% retracement first and protecting my entry with a stop loss at break even, just in case the price wants to come back around. But basically, my break even here is like 167, because I got all the way down here, like at this price point right here, it went to like 165 that day. So my price point, is like, let's say 170. I could probably get out at break even and cover the trading fees. So I'm there just kind of waiting as my first entry for that next wave. And then if this thing pops out here, as it gets to about here, I'll add to my position and still have a good average that's kind of like within the wedge, if that makes sense. And then I'm kind of just waiting for it to come all the way up to here. And based on time, I'm thinking that it will probably take about maximum 2 weeks to achieve. So this is how we put all the pieces of the puzzle together. And we use Fibonacci with Elliott Wave Theory to give us our idea of where this thing is going to go. Because it's just an emotional game, guys. Like once you get, the biggest thing is controlling your own emotions. Once you control your own emotions, then you have half of the battle done. Half of the battle is done right there. Once you can control yourself to, see the price going up and not have that fear of missing out, like, oh, I better buy this, it's going up, get rid of that. Once you get rid of that and you say, oh, I think this is going up, let me be patient, let me wait, let me buy everybody else's shakeout, let me buy everybody else's fear and their panic, then you are first on the right track. Then if you try to strategically get that placement based on, this map of how the price is going to unfold and how we're going to get those points based on the Fibonacci, then it's the other pieces of the puzzle right there. And then we kind of use everything else as confluence. Everything else is confluence to kind of show us that we're pointing in the right direction. Meaning here, just to finish up, because I got to go in a couple minutes here, here I would use a couple things as confluence here. One, it's confluence that we're running into this 12-hour cloud. It's confluence that our stochastic RSI, is crossing over. Okay? These are confluent factors. Okay? When you add all those things together, it gives you, a good indication of a trade. So I always kind of remember that, guys. Like if you guys are taking a trade, don't take it just based on one indication or one idea that you have. See if you can get a couple things that are pointing you in the right direction that you can use as confluence to build your opinion that that the market is going to go in the direction that you think. Okay, so that's it for today. I'll catch you guys on Friday, and yeah, until then, keep stacking the Bitcoin, guys. There's a lot of money to be made in these markets, and enjoy. Take care.